identifying what the problem is for a lot of people is what's that shortfall look like outside of your Social Security and maybe a pension?
And there are some really big companies that pay dividends that you would be like, oh, like this company is very successful. I'll just put it in there. But turns out you'd be surprised the company doesn't have a lot of free cash flow.
So what you want to do is invest in a business that can prove every want to hear your stories.
If you have a cool testimony you want to share, reach out to us. Anything like that.
Absolutely.
Hello, everybody. Welcome back to the Legacy Life podcast today. I hope you're doing well. Today, we've been talking about estate planning and retirement planning,
long-term care,
a lot of these different topics when it comes to full comprehensive retirement planning. There's a lot of different steps, but we're kind of shifting gears today a little bit, and getting into a little bit more specifics as far as the income piece goes. But we're going to talk about dividends today, more specifically the heartbeat of dividends, which starts with understanding what free cash flow is. So, if you want to get us started here and talk to us, what is free cash flow when it comes to dividends?
Yeah. I was just going to say, too, you're right. I mean, on the income piece, when it comes to people looking at the heartbeat of their retirement plan, cash flow is king. It helps alleviate all the other issues we've been talking about the last few weeks, making sure that at the base of your retirement plan, that the income piece is in place. It's the most important foundational piece of any retirement plan is the cash flow, the income.
Yeah. And it just, before we get into it, also, I think we might have said it in another episode before, but I think it's important to highlight again that when someone is entering retirement, you spend most of your life focusing on growth of your cash.
Yes.
Where there isn't anything wrong with necessarily growing in retirement, but it's like a mindset shift from growth to return on cash.
Yes.
Because cash flow is what is important. You're looking for income because all of your income has stopped.
Right.
When you retire,
Yeah.
So.
Paycheck from my job ABC is gone.
Yeah.
I'm not contributing to my 401k anymore. I'm not getting the company match anymore. A lot of things shift at that moment, right? When you step off the on-ramp, yet sometimes we carry the mentality of what's been happening continues to happen.
Right.
And it's kind of a shift to say, oh, now it's about distribution of my assets back to me. And, and maybe we'll do an episode on, identifying what the problem is for a lot of people is what's that shortfall look like outside of your Social Security and maybe a pension.
Right.
Maybe you have some rental income. Maybe your base income is a certain level, but what do your assets have to do in order to, keep you at the income level that you need to be at in inflation? So you're right. It's a huge shift from accumulation to what we call distribution.
Right.
All right. So from from accumulation or growth to a distribution mindset can take a shift. Where you got to take a hard look at it. How does that work, and what is the most efficient way to get your assets to work best for you? And so one of those potential ways that you can do that is through dividend investing. That's one of the particular strategy that sometimes can perhaps be a really great way to help with that transition from the growth to the distribution. So we're going to talk about how do you know, if you're going to use dividend investing, we're talking specifically today, how do you know what a good company is and what are the metrics you look for to say, hey, is this going to be something that I can rely on for a long period of time, for a period of years throughout my retirement? How do you know if it's reliable or not? And so one of the metrics we look at when we look at dividend investing is something called free cash flow.
Right. One of the very important metrics we look at as well.
Right.
So it is a good indicator of safety for your dividend income and longevity of a company.
Right. So at its base form, free cash flow is, let's say Your company A is making $10,000 in income, and after they spend on their expenses, let's say they spend $7,500 in expenses, so they've got $2,500 left over. The $2,500 left over is what we call the free cash flow. It's what's left after the expenses. And in the case of, dividends, we're looking at this on a quarterly basis with companies. And so if a company has money left over, like let's say $2,500, that's money that can be used to pay a dividend back to your shareholders. A portion of that or some percentage of that, they can say, here, we're going to give back to the investors in a form of a dividend. And that can be income. So, if you put it into just look at it like a family, you got a mortgage payment, you got to buy your kids new shoes, got to buy groceries, you got the normal monthly expenses, and that can add up real fast when you are running a household. Memberships and the whole 9 yards. So if the family says, okay, taking care of all these things is important, we're doing that, but hey, it'd really be nice if we could go take a vacation together. Well, to do that, there's got to be some free cash flow left over in order to be able to afford to go do that. If there isn't any free cash flow and you go on the vacation, then you start dipping into things like savings and credit and other things in order to be able to do that. So companies work the same way. A comes in, expenses go out. If there's something left over, that's what gives them the confidence where they can pay income or a dividend out to their shareholders.
Yeah. And some people may ask like why they should care about this specifically because, there are a lot of different dividend paying stocks and there are some really big companies that pay dividends that you would be like, oh, like this company is very successful. I'll just put it in there. But turns out you'd be surprised the company doesn't have a lot of free cash flow. And so the dividend payout might not be as pretty as another company that's not as big but has a lot of free cash flow.
Right. And so, if you're looking at the financials of a company and you're like, hey, they're paying a dividend, but man, their free cash flow, they really didn't have any, but they're still paying a dividend. That may be a cause to say, well, hold on a minute here. Where's the cash coming from in order to pay this dividend? Are they dipping into their long-term retained earnings in order to do that? And if so, how long can they actually keep up with that if their free cash flow, if they don't have a lot of that consistently quarter after quarter after quarter? So, you're investing in a business. What you want to do is invest in a business that can prove every quarter that they can afford to pay you. Right. That's really what you're looking for, right? And at the same time, as a dividend investor, there's another thing with dividends you can do that is also really powerful, especially with a company that can afford to pay you dividends consistently. And that's if there's some people who never actually necessarily see the cash from their dividends because they're just reinvesting them. Right. And so by reinvesting them, you're buying more shares and buying more income, but the company is still sending you real money and a real value every single month or every quarter. When they're paying that dividend, they're sending it to you consistently into your account, and they're continually giving you something that's real and tangible.
Right.
Even if you're just reinvesting it, or whether you're taking it as income, either or, it's still the same concept.
And did you spend a single cent of your own money buying yourself more income and shares doing that?
Exactly. We did not.
Yeah.
You didn't have to write your own check to make that happen. So I like to kind of compare a dividend payout to say like a company match in a 401k. It's like you're an owner of these companies that are paying dividends and they're giving you a match every quarter, right? They're paying you something that's going into your account, just like your company used to into your 401k, say, like your 4% match or something.
Right. But the thing is, after your initial investment, that employer will just keep matching it and you don't have to put anything else in if you don't want to.
You're not making any additional contributions yourself necessarily, which is awesome.
Right.
Yeah, I love dividends.
And that's where the compounding factor comes in.
Yes.
You can really do some cool things.
Correct. Okay, so On the other fact, or another aspect of this is what we call the payout ratio.
Okay.
Okay. How much is too much? So a company has free cash flow. How much of that free cash flow are they giving to the investors?
Right.
Okay. So a company made $10 million in a quarter. Let's say they pay out $5 million of it in a dividend, 50% ratio. That's healthy. We like to see anywhere 75% or less of a payout ratio is pretty good.
Why is that?
Well, because what if it's 120%
Right.
payout ratio, right?
Right.
Because if they're giving away all their free cash flow, do they have any retained earnings? Do they have any savings? Are
Right.
they able to continue to? What if the company goes through a rough patch economically because of whatever's happening in the economy,
Right.
or they have a product snafu, or they have a little blip like we talked about Chipotle, Mexican Grill had an E. coli breakout several years ago, and we're like, whoa, investors panicked real quick.
Yeah.
Company's financially healthy. They could survive that, fix the problem, and move forward. But if a company is short on cash and they're paying it all out in dividends but not retaining anything for the company, that can be like a little bit like, well, how are they going to survive an economic downturn, recessions? Do they have enough cash to survive and get through a low economic time?
Right.
These are things that are important to look at.
Yeah. And an example of a company that does have a lot of retained earnings that I hear you talk about a lot is ExxonMobil.
Yeah.
Saying like if they stopped business today, they would be able to pay their dividend holders
Another 10 years.
another 10 years
Yeah.
or whatever
Without a
of
problem.
dividends without the problem because they
Yeah.
have so many retained earnings.
Yeah.
And so that's what you kind of want to look for in these businesses.
Right, and that's a great thing to kind of differentiate. The free cash flow we're talking about is on a quarterly basis. This is what was left over this quarter.
Yeah.
Right. That doesn't so if they, in this example, if they had $10 million and they gave $5 million away in a dividend and they have $5 million left over, it may not sound like a lot because it's only $10 million here.
Right.
But we're talking about companies that might make $750 million in a quarter and give away 50.
Right. Exactly.
Right. And the rest of that is then going into their account. Right. And there's probably other dollars over there in their retained earnings. So free cash flow left over is not necessarily everything they have in their bank account that they've been accumulating over the years of being in business. It's just the new earnings.
Yeah.
Okay.
Exactly.
So what if you see a company give away 100% or more of their free cash flow in a quarter? Red flag? Sure.
Right.
It can be a red flag, especially if you've seen them do it consistently for several quarters in a row. And you start to see that the earnings are beginning to erode, the savings are beginning to erode, over time. You could be like, this may not be good long term. If it happens once, as long as you understand why it happened one time,
Right.
and it's not like something that's going to be consistent, it doesn't necessarily mean it's bad just because it happened one time.
Right.
But find out why it happened the one time, and that you're pretty confident that's not going to continue. There's ways of, there's a lot of ways to find out companies' earning calls, and there's articles and they give out reports. So you can find this information. It's not hard.
Yeah. So the principle of dividends is great, but research companies and,
Yeah.
pick
Knowing
ones-
what you're investing
knowing
in is
what you're investing
very
is-
important.
Yeah.
Yeah.
Exactly.
Like a lot of good examples, like if you're talking about a company like you just saw ExxonMobil or like Johnson & Johnson,
Yeah.
Thanks for those Q-tips and
Exactly.
baby oil and
Yep.
all the things, right? These are companies that have been doing this a long time and have a history that you can see of being able to pay a consistent dividend and have a lot of good free cash flow.
Right.
Microsoft, Apple, even NVIDIA, that's one of the big companies now. AI chips and a lot of people might say, well, I don't know if NVIDIA is going to be king forever and
Right.
because that market's changing. True, but even with NVIDIA's massive growth, it's happened very quickly. The amount they're paying out of their free cash flow for a dividend is very minuscule.
Yep.
It's very small. So they're retaining a ton of their earnings, but still paying cash to their investors.
Yep.
Showing that they actually could continue to pay it for years. Even if something changed in their company today, like other competition came in and they weren't able to be as competitive for some reason, they could still consistently pay for a long time into the future because of their retained earnings.
Yeah.
So those are things that give you confidence as an investor. If you're in those kind of companies and you're retired, you have confidence that I have income coming for a long time that is really doesn't have a lot of just not a lot of fear around it not being consistent.
Yep, exactly.
Right. So what are some other things people can watch out for?
Well, I know.
Okay.
Talking about knowing what you're investing in. Yesterday, we went to a water park.
Yes.
For my brother's birthday.
Yeah.
And there's this big slide.
Mm-hmm.
And basically, it's a 4-man tube. So you get a group of 4 people and you go down. So it's a really big slide.
Mm-hmm.
And basically, as soon as you turn the corner, so where the lifeguard can't see you, everyone jumps out of the tube. And then basically, it's like you try to get back on the tube by the time you get down to the bottom before the lifeguard sees you. And if you get down there and you don't make it back on the tube, the lifeguard yells at you and everything. So it's kind of like a race against time.
Yes.
But as soon as you turn that corner, it's like a free-for-all. Like, everyone jumps out, and then everyone's just, like, sliding around everywhere, trying to get on the tube, bumping into people. And, I got absolutely obliterated a few times. And my body's just so sore.
Uh-huh.
But, yeah. Definitely worth the investment, though.
Worth the investment.
Worth the investment.
Okay.
Yep. But watch out for those water slides.
So the proverbial water slide.
Water slide.
In this example is equated to what?
It's equated to, if you invest in a company, I may just be pulling stuff out of my butt here, but if you invest in a company and, the road might be a little bit rocky.
Yep, wild and crazy.
But at the end of the day, it paid off because you read about the free cash flow or the free flow of jumping out of the tube and having a good time, although it might have been painful at times.
Uh-huh.
And then the retained earnings is the retained memories.
But you get out of the tube, you're like, it's still okay.
Exactly.
Even through the rockiness.
Yep. And I did my research of the slide as I went down it, figuring out, okay, this is a good time to get on the tube. If I don't get on the tube before this point, then I won't ever get back on. And then you're going to get yelled at by the lifeguard. So you got to do your research as you go through the tube a few times.
Yeah.
But so it's like the proverbial water slide, if you will.
All right.
Yeah.
Hey, thanks for that.
You're welcome.
Yeah. Awesome.
Yeah, I just thought
that wasn't even in the script. I like that. That's right off the top of your head. I love that.
Yep.
Yeah.
But by the way,
investing can feel that way though.
It can. I forgot to say in the beginning of the episode, but we hit 100 subscribers last night.
Oh, awesome.
Yeah.
Everyone, thank you for hitting subscribe and walking this journey with us through all the water slides and waterfalls.
Yes.
And I guess before we cap this off, we should always say this at the beginning, and I always forget, and I put at the end, if you haven't subscribed, hit that subscribe button.
Yeah. And if you have and you could hit it again, I'd ask you to, but you can't.
But you can't.
But
and set that alert so that you get notifications for every week that when we release our episode. We'd love to have you along on this journey down the water slides.
Yep. And in between 100 and 200 subscribers, we would love to interview people that have any stories they want to share.
Yes.
Or anything like that. So if you do, reach out to us. If for some reason I've had the thought, like, maybe the link in the description isn't working sometimes just because it worries me, so I always click on it just to make sure. But if there's a link that doesn't work,
let us know.
Leave a comment or something, you know what I'm saying?
Yeah, right.
So we can fix it. But yeah, reach out to us. We'd love to hear your story.
Absolutely. And
it doesn't have to be about finance. It can just be about life and legacy in general.
Yes, absolutely. We want to hear your stories.
If you have a cool testimony you want to share, reach out to us. Anything like that.
Absolutely. Mm-hmm. So, to finish off our water slide adventure today.
Mm-hmm. To get back on the tube.
What to watch out for when you're on the tube going down the water slide and going through the rockiness. And
other flailing humans.
Yes.
In a small space.
Right. Because when you're with other people in that small space, they're all making decisions too.
Exactly.
And some people are getting off, and some people are trying to stay on. And sometimes you might feel like you got to go with the crowd. Well, if they're all leaving, maybe I should get off. So how can you have confidence to stay the course and not feel like you're running by the emotions of what the market's showing you, right? So what do we watch out for? One thing we want to watch out for in the dividend world is there's sometimes people chase something called the yield of the dividend, the high yield. And that can be the trap. People are like, ooh, this dividend's paying 10.5%.
I could stay off the tube for a little bit longer.
Yes.
And get more fun out of it, but
Mm-hmm.
you're gonna miss the tube.
Exactly. This high yield sounds great. Man, 10.5% yield on my money sounds awesome. The thing you got to watch out for in the high yield trap is, why is the yield so high? Because you have to remember that there's an inverse relationship between the value of the share, how much it's trading for on the market, and the yield. If the price drops in the stock, if the price drops, the yield goes up. Okay? Now, with a company that, like we were just talking, let's say Johnson & Johnson or Exxon, there will be price fluctuations in their stock, for sure. There will be ups and downs. However, their yield stays pretty consistent. Their cash flow looks good. But if a company's stock price drops a lot all at one time and that yield goes up, the question you have to ask is, why did the stock drop so much? That yield's high, but why is the stock price so low? That could be an indication that there's something wrong in the company.
Yeah.
Okay? So a high yield might mean the stock price, like I said, tanked. Why? So if you're not watching the cash flow trends, that could be an issue for one of your positions in your portfolio if you're not watching closely. So look at trends, watch the free cash flow growing over like 3 to 5 years, like a good chunk of time, not 6 months, right? And is it like a slow leaking roof? Is it slowly eroding? Or is it just a blip on the radar? Okay. So even with great past performance, your job as an investor is never done. I like to say you always want to keep your eye on the ball.
Yep, exactly.
Okay.
Yeah.
So you got to keep assessing, just like your home budget. You don't do a home budget once and then walk away and say, well, we did that, done, check. You got to keep evaluating.
Right.
Okay. So last but not least, we always like to throw this in here too. Several, I'd say early on in our episodes here, because this is episode 23 now?
23-ish, yeah.
Wow. That kind of flew by.
It did, yeah.
But some in our earlier episodes when we were first starting, we of course did like some episodes for kids.
Yeah.
And how to help your kids understand how to begin building budgets and all those kind of things, which was fun. This is something you can really, educate your children on. And, hey, if you're starting to run your own little business, here's how free cash flow works. Here's how dividends work. It's a very simple concept that you can teach them.
Yep. A very powerful one.
Right. And show them how, if you want extra free cash flow per month, maybe $3 Gatorades isn't the best thing to always buy on every trip,
Right.
Maybe 1 instead of 5 this week, right? How to curtail their spending and retain earnings. And you can teach them that whole concept through their own little personal budgeting. And then you can relate it to the inner tube life of going through the markets and investing and buying assets.
Yep.
Yeah.
You could take them to a water park and teach them.
You could. And you could fall off the inner tube with them and say, see, this is what happens.
Right.
Yeah.
Exactly.
I think we have a great visual aid now for families and things.
Yes, I think so too.
Yeah.
Mm-hmm.
Of course, the vacation, if you have free cash flow, do the vacation.
Yeah,
Do the
of
water
course.
park.
Yeah. If you have some retained earnings. To...
Some retained earnings so you can take the trip.
Yeah, exactly.
Yeah. So free cash flow is the heartbeat of a good dividend paying company. And when you understand it, when you watch it, you can really have great income from great assets for a long period of time, especially in retirement. So if people want to talk about this and maybe have a free analysis of what their income plan looks like long term, I don't care whether you're in your 30s or you're like 1 year away from Medicare.
Yep.
It's always a good time to evaluate and look at this. Buying assets throughout your entire life is always a great thing to learn how to do with your free cash flow. So if this has spoken to you and you want to learn some more and want to have a free evaluation, there's a link that Caleb is testing to make sure it works, as he said earlier. And it gets our calendar, and you can book a short appointment with us, and we can just do an evaluation for free and see where you're at. And if we can help you, great. If we can't, great. But the most important thing is that you're taking control of your financial future, and that starts today.
Yeah.
So until next time.
And thank you all for 100 subscribers. We appreciate all of you.
Yes.
And we're looking forward to the next 100 people that we can help out too.
Yep. Thanks so much.